Hello and good morning, listeners. Welcome back to Almus Market Mornings with Jayaram Krishnamurthy. Here, quick dive into the financial market updates. Now, listeners, although we saw a backflip by the President Trump on tariffs and Powell situation, but the move or rather, it did not move the needle quite significantly. A lack of actual progress has kept this limited movement on the currency and the gold price movement. While the trade related booms continue, inflation concerns are also popping up, with Japan's Tokyo CPI year on year inflation rising to 3.5% for the month of April from 2.9% seen in the previous month. On the domestic front as well, even though we have seen the FIIs coming back into the equity markets, the FPIs have been pulling out almost $1 billion worth of debt as the yield spreads have narrowed in the month of April. Jacob, what is your take on such developments and what should we be expecting going forward?
Good morning, Shikhar. Actually, market is in kind of holding pattern right now as the news related to tariff negotiations are trickling in. So it's not a very fast progress that we are seeing. But yes, market believes that negotiations are on, and we'll have something better to cheer about going forward. In fact, yesterday, one of the statements from China said that if US really wanted to solve the trade issue, they will have to lift all the unilateral tariff measures against it. So they're holding on to a very strong stance, and it's not we have not seen any statement from China to indicate that they are ready to negotiate. So that keeps the market on hold. But apart from that, I think there was also a statement from Besant which said that they are almost close to signing a deal with South Korea, and that's one positive news that we have heard. And in Korean markets have taken it positively today, rallying. And so, in the absence of major tariff-related news on monetary policy, market had a look at the latest data yesterday. We had the jobless claims data that came higher, but was as expected, but still shows it has been very steady, hardly reflecting any feared slowdown in the jobs market. And continued claims, in fact, dropped much more than expected, reflecting the ability of people who are out of jobs to find alternate placements. Durable goods orders came at a staggering 9.2%, a figure that not only was much higher than the expectation of 2.1%, but significantly outpaced the previous rise also. So, when there is such a jump in the durable goods orders, it indicates a rapid acceleration in economic activity, at least in one phase, and a positive sign for the health of the economy, and an evidence that the expected sharp slowdown is either misplaced or at least delayed. So hard data so far is not reflecting any feared slowdown of the US economy, and that is what is keeping even the Fed on hold. Although we did have the existing home sales coming at a much lower number, but home sales have been on the lower side for quite some time now because of the high interest rates, and until Fed starts lowering interest rate, this sector is going to be subdued. So that is these data were somewhat dollar supportive yesterday, although there is no movement in the yields, which stayed somewhat lower. Stock markets made further gains. And apart from the data, we also had some interesting statements from Fed members. Like Waller said, he was willing to look through the tariff related price increases, and that rate cuts could come from rising unemployment, which he expects can happen with big tariffs. So that was a kind of a statement that made the market rethink about Fed's near-term move, although May is going to be a hold. June could be something very interesting. Another Fed member, Hammack, also said that Fed could move in June if data is clear about the economy's state. So these statements actually gave some support to the market as well. In Europe, Germany's IFO business climate indicator edged higher in April 25, the highest since last July, and firmly outperforming the market expectation. The improvement came mainly due to policy of the government to aggressively increase public expenditure on infrastructure, defense, and businesses, and to trigger some traction in the growth in the face of tariff threats from the United States. And as I said, the Japanese inflation number was much higher than expected. And in fact, the statement from Ueda recently also indicated that he will keep raising interest rates if their forecasts that underlying inflation will converge to a 2% is material. Now it's not just 2%, it's well above 2%. So I think there'll be very little justification for BOJ to hold back their interest rate hikes, unless, of course, the tariffs are maintained higher level and the growth takes a much larger hit. But in my view, I think uh, somewhere in June, BOJ is likely to hike the interest rate next. And also, let's also not forget that the negotiations between the US and Japan also includes discussion on currency. And while they are downplaying the currency related discussions, I think the weak yen is one of the things that's hurting the US trade, and that's something worth watching out in the coming days as the result of the negotiations come out. So as we mull through these numbers and await more details on the tariffs, market has been buying back more of US assets, and we saw continuation of the rally in the stock market. Now we have the S&P 500 and Nasdaq recovering 7.6% and 9.5% from the recent lows. Dow Jones recovered 6.5%. Bond prices have been higher, with the yields on 30-year and 10-year both falling by 20 basis points from the high that was seen during these weeks. So these developments indicate to me that not only there is short covering, but also perhaps investors favoring a buy at afresh at better values, even as the news flow get better. On the dollar, it's been ranging. It's not really making a dent on the lower side, nor making big gains. Definitely, as more investors buy back some of their US assets, because it's not as though they're shunning the US totally. No, it's not possible in the immediate time frame, because most investors are also looking for more credible alternative than what is already available. So in the face of that, if the news from US turns better for the tariff and other policies, we might as well see some more buyback of the US assets. But not to forget that the medium term view on the dollar, because of the various policies which indicate US is not really going with the global view in mind, and also their leadership role is also diminishing. So these are actually going to keep the dollar subdued, but in the short term, I think some buyback of the US assets and can create the US demand that will keep the dollar somewhat on the correction zone. I expect dollar index to move towards 101.50, currently at 99.60 euro, perhaps 1.12 or slightly below that. GBP, with all their inherent problems of fiscal, will be quick to retreat if the dollar undergoes a correction, can go towards 1.30 as well. Dollar yen looks limited in its up move, but maybe 143 could, or 144 could cap it, and then we'll await what discussion come about the yen from between Japanese and US officials. As far as the Indian market is concerned, there was surprise strength in the INR yesterday, almost gained 20 paisa from the level where it closed on the previous day, but from the high of yesterday of 85.66, we were down to 85.25 almost, and that's a massive move of 40 paisa. And this was driven by a very large inflow from FIABO for the stock market, nearly $950 million. And perhaps once the market sensed that the investors are not overly concerned about the developments in the J&K state, and still not seeing any major unsettling action from the government, perhaps these flows, which are probably pre-committed, have taken the dollar down to its support near 85, 10, 20 region. But these levels, I think, should hold, because we have seen the central bank buying at these levels. Dollar index is likely to correct, and also Chinese yuan does trade still near around 7.30. We don't want rupee to be too strong against the Chinese currency, because that will increase our trade deficit with China. So all in all, markets are on a holding pattern, and rupee likely to still move between 85 and 86 range in the coming weeks, awaiting more developments on the border front. And the overall dollar looking for more correction. And of course, we have a weekend coming up. So the developments over the weekend will, of course, determine whether how we move on the currency front as well as on the asset side. Not to mention that, silver is, of course, showing some signs of catch up. Gold has had a very big rally this year, whereas silver had been relatively subdued. But now it is just showing some signs of catching up, and just watching out for a break of $35 on the silver, and that break could easily take prices up by another 10% or so. That's the expectation. Thank you.
Okay, JK. Yes, we've been seeing some sort of glitter in silver as well, although gold outshined for the longest of time in the recent history. But silver shows the signs of catching up, and as JK mentioned, there is some potential on the upside as well on the break of such levels. Having said that, on the Indian front, there was a surprise strength in INR, and it is also seem to be continuing this morning with the currency pair trading around 85.15 at present. So, folks, we do expect some sort of support around these levels with the central bank's presence, as well as the continuous or the gradual move of the one on the higher side, also having an impact on the trade deficit front. On the global front, as we've been talking about, we've seen South Korea being close to an agreement on the trade front from US, which was shared by the market. But other than that, China mentioning that unilateral tariff needs to go before negotiations begin is another factor, which kind of has kept the uh, negotiations on the questionable set. Although the market does believe that negotiations are still on. With the trade tariff update being limited, people focused on the economic factors, which is also seem to be bringing in some sort of relief against the expectations of this sharp slowdown. The hard numbers does suggest that there can be some relief against the sharp slowdown expectations. On the BOJ front, they are likely to continue on the rate hike path, while the stimulus in the Europe looks to change the sentiments, at least as suggested by the EFO numbers. That's it for today, folks. So while we continue to mull over these numbers and the developments over the weekend, I'd like to end today's podcast saying DGIF. Thank God it's Friday, and we shall come back again on Monday with another round of update for you. Thank you so much for listening in.